PepsiCo's second quarter earnings out this morning are going down easy for investors. Shares are up about almost 2% in the pre-market as the company clobbered analyst forecasts across the board on strength in beverages and snacks. The stock is the #1 trending ticker on the Yahoo Finance platform right now. PepsiCo also revealed a new $1 billion cost-cutting program and lifted its full-year sales and profit outlooks. Joining us now is PepsiCo Vice Chairman and CFO Hugh Johnston, who I should note is back in the company's headquarters in New York. Good to see you as always, Hugh. So what was interesting to me is that the Frito-Lay business, sales up 6%, operating profits up 7%. Why has that business maintained its sales strength? Last year it was up about the same while consumers are getting more mobile again.
Yeah, good morning. Good to be with you all, Brian. Frito-Lay is just such a strong business in so many ways, has so many powerful brands. The innovation machine is really hitting on all cylinders right now. And what you see happening inside the business is just this continuation of a trend where people are seeking to snack more. And whether they're doing it from their homes, which obviously lifts the take-home channels, or whether they're doing it now much more out of their homes with mobility increasing, they're seeing terrific growth in the food service business, which almost doubled, and the convenience store business was up double digits. So Frito's pretty ubiquitous. Wherever you are, there's a snack there for you from Frito-Lay.
I was able to catch about the first 25 minutes of the earnings call this morning. Really a lot of focus on pricing and where you will take pricing later this year. Usually around Labor Day, I believe you guys raise prices. But how much do you think you will take prices up this year because of what we're seeing in terms of raw material inflation, labor inflation, you name it?
Yeah, I mean, the way we think about pricing is it really is a reflection of the investments we make in our brands and the innovation that we have, because those are the things that consumers are willing to pay more for. So we think of it as more connected to delivering value to consumers. Obviously, with cost pressures, it puts that much more pressure on pricing. And in fact, we will be taking pricing post Labor Day. It varies by business as to how much is going to be in Quaker versus Frito-Lay versus the beverage business. What I'd point out is in the second quarter, our pricing was up about 5% in the North America businesses. I think you'll see us take good, strong price increases, which are really reflective of the fact that even through the pandemic, we kept investing in the business and building the brands and building capacity to fulfill sales. So we do think our products are worth paying more for, and we think consumers will.
Hugh, it's Julie here. I want to delve a little bit more into the mix question that you were just talking about in terms of at home or out in the world where people are consuming your products. Are you guys agnostic when it comes to channels? Are the margins higher in particular channels? And are you finding that with those increases in cost, that some channels are more resistant to increases than others?
We do see margins a little bit higher in the away from home channels in a lot of ways, because if you think about our distribution system, it adds so much value in those channels. That said, in the take-home channels, our margins are quite good as well. So there's clearly some margin mix benefit into away from home, but it's not a massive dislocation by any stretch of the imagination. In general, we found that we can increase our prices pretty well across all the channels. Again, I think it comes back to, as much as anything, we're important to our customers. They recognize the fact that we're bringing a lot of value to their shoppers, and as a result, they understand every year we're going to charge a little bit more. So I expect that those will be productive conversations that we'll have over the course of the summer, and then you'll see the price increases in the fall.
Hugh, it's Miles here. I wanted to ask about a couple of things you guys had in the release, particularly your restructuring plan going into 2026 now, and also on the shareholder returns. Buying back, I think, $5.8 billion in stock, but no planned repurchases for the balance of this year. Specifically on the restructuring side, just curious how you think investors should be thinking of this plan in the context of a business, as we've outlined this morning, that is seeing the kinds of organic sales growth. I think you would take any time and likely would not have expected, maybe wind back the clock a few years ago.
Well, I think in a lot of ways, as the world has evolved, right, whether it's e-commerce or the ability to manage the company more efficiently by leveraging digital capabilities, we're going to need to continue to invest in those things. At the same time, there are other areas of the business where by virtue of automation or by virtue of sourcing differently, we can actually decrease costs. The restructurings enable us to basically move resources from places that we want to have less into places that we want to have more. The net of that is from a financial perspective, we've said margin improvement of 20 to 30 basis points. We'll continue to see that type of improvement, I'd expect, in the future. It's going to vary from quarter to quarter, but in general, that's what you'll likely see out of us when you net the investment and the productivity savings. In terms of cash return, you mentioned $5.8 billion. That's the dividend that we're paying. That's not share repurchase. We said this year we're pausing on share repurchase, and there's no change on that this year.
Hugh, as part of just following up what Miles mentioned on the restructuring plan, a lot of talk about automation, automating more processes. How much will your workforce size have to change because of those new moves?
Well, clearly, when we automate things, the first thing we're trying to do is take repetitive work and have it done by machines rather than have it done by people, because the machines are more capable at doing that type of repetitive work. So obviously that has an impact. But at the same time, because the company is growing so quickly, if I look at our history, our employment numbers have continued to grow by virtue of the fact that as a bigger and bigger company, we do need more people. So we'll just see people, I think, move from one type of work to another type of work. We do a lot of retraining in that regard. And net is, PepsiCo's been a great place to work for an awful lot of employees for a long period of time. I expect it'll continue to be.
And Hugh, before we let you go, about a week ago, there was a good feature story in the Wall Street Journal discussing new categories beverage makers might want to get into to help relieve the stress consumers are feeling coming out the other side of the pandemic. I know you've launched a product called Driftwell, but any other plans to launch in that category?
We have another product called Soul Boost, which is also a functional beverage. I think you'll continue to see us in functional beverage spaces across the board, whether it's oriented towards sleep, oriented towards building muscle with protein, oriented towards energy with obviously lots of different energy drinks that we play in the category. So to the degree that the consumer is looking for a functional benefit, I expect over time we'll probably be there with a pretty good product to meet their needs.
Well, send those protein drinks to my co-host, Miles Udland. He lifts a lot of weights in the garage. He'd be very excited to try them.
Happy to do it.
All right, fair enough. PepsiCo Vice Chairman and CFO Hugh Johnston, good to see you.
Good to see you. Thanks, guys.